The RBA flags further increases in interest rates to tame inflation. We're going to look at how high interest rates are going to go today. We're also going to look at when interest rates might actually get cut and what it's doing to borrowers who are facing a $922 increase on their mortgage repayments. Let's have a look and see what's actually happened. So we see yesterday the Reserve Bank increased the cash rate by 0.5%, and the RBA governor insisted that more interest rate rises are required to cool inflation and deliver a stronger economy to sustain the low unemployment after the central bank once again delivered a fifth consecutive monthly increase that officially brings the cash rate up. As we can see here, the cash rate now is at 2.35 officially, and we've seen the fastest rate of change in interest rates in over 7 years. And I mean, it took us 4 years to get the cash rate down from 1.75% to 0.1%. And now in a matter of 5 months, we've increased a very substantial amount in such a short period of time. Now, economists have said that Dr. Lowe has opened up the door to slow down the pace of change. So we might actually see that these 0.5% increases slow down in the coming months. And the 50 basis points increase has officially put us to a 2.35% increase. And looking at it over the past 20 plus years, we can see where the cash rate has gone, and this is one of the fastest increases that we've ever seen on record. In 1995, we can see similarly a very fast increase. Now, the RBA is committed to taming soaring inflation, and Dr. Lowe said that achieving price stability was a prerequisite for a strong economy and sustained period of full employment. We're also seeing that Dr. Lowe has restated that his desire to keep the economy on an even keel and seek inflation to return within their bandwidth, which is 2 to 3%. Now, inflation is expected to peak at 7.8%, and they are trying to get that back down as quick as possible. There are some things that the Reserve Bank governor is very careful about. We saw previously in some comments that he said that the cash rate wasn't going to change until 2024. Now, he's sort of keeping the door open, saying there's no preset path or plan moving forward, and it's really going to depend on the data that's coming out. We also saw the other day, we did a story on this, Commonwealth Bank coming out and saying there is a 3-month lag period between when the cash rate is changed, between when the bank needs to recast. That takes 30 days. Then they have to give clients 30 days notice, and then the mortgage repayment to come out 30 days later. So 3 months from when the official cash rate is determined or advised to when it actually hits the bottom line for borrowers. So a lot of this data that the Reserve Bank is going off is delayed. We got to wait for, the spendings data to dip because of borrowers and them being hit in the back pocket. So definitely going to be interesting to see how this one plays out. And once again, Dr. Lowe said that the path of achieving the balance is a narrow one and is clouded by uncertainty, and not at least because of global developments. And we can see with what's happening in the US, we're seeing New Zealand, obviously, they increase rates far quicker and a far quicker rate than Australia did. We're a little bit slow off the mark. And Dr. Lowe said that the economy continues to grow solidly, and the central bank expects the unemployment rate, which is currently at a 48-year low at 3.4%, to decline even further. And we've seen some pretty significant impacts of this low unemployment rate. We've seen airline industry struggling to fulfill positions. We can see potential for more international arrivals and more international working visas being permitted. And this is certainly something that such a low unemployment rate has some knock-on effects. And the cash rate is now at the highest level that we've seen since December of 2014. And there is poised to be further increases by the central bank as they seek to lower inflation, as we talked about earlier, which is likely to hit that 7.8% by the end of the year. Now, with yesterday's decision of that 0.5% increase, what that means for households on a $750,000 mortgage is that their mortgage repayments will increase by about $216 per month compared to last month, and $922 increase per month from when rates increase initially in May this year. So this is something that is hitting the bottom line for a lot of borrowers and certainly is making a bit of a dent into their cash buffers and as well as their ability to spend on discretionary items. Now, Dr. Lowe said in his board meeting that there's no real preset path to move forward on, and as the months move forward, the plan will become more and more clearer. The markets have priced that the official cash rate might actually hit 3.2% up to 3.8%. So that is a little bit higher than what was initially predicted. We did see that the markets previously had put the cash rate much higher, so that's come down a little bit, and we're seeing the banks still being very certain in terms of what they're expecting. So Commonwealth still sort of sitting in around that 2.6% is what they're saying. They're saying that they expect that there will be a pause with cash rate increases, and we might actually see another 0.25 rate rise in the coming months, or up to another 2.25% increases. So that'll either get the official cash rate to 2.6 or 2.85. And Commonwealth said that their base case scenario sees that the Reserve Bank deliver one or two more further increases of 25 basis points. So that's 0.25%. That will happen in the next 1 or 2 months. And they believe that the cash rate will get to 2.6 to 2.85. So they've previously been very firm in saying they felt that the cash rate would hit 2.6. They're coming out and saying that they expect it to hit anywhere from that 2.6 to 2.85. And then they're seeing that there will be a pause. So they think that the Reserve Bank will pause for at least a few months as the tightening cycle of the cash rate hits that upper limit, and they'll wait for the data to come through and indicate if they need to continue to take the rates higher or if they've done enough. Now, they do want to make sure that we don't have a hard landing. The Reserve Bank is obviously going to be very eager to see the data coming through. And as we talked about earlier, the Commonwealth Bank saying there is a 3-month lag period. So the 5 rate hikes, there hasn't been enough time or long enough period for us to really see what the second and third order consequences are going to be. Now, Combank's position is estimating that we'll peak effectively at that 2.6 to 2.85. But they also said the Reserve Bank governor's got a speech planned on this Thursday, so tomorrow, and the speech is titled Inflation and Monetary Policy Framework. So in that speech, we might actually be able to get a better understanding of where Philip Lowe is and where the Reserve Bank might be going with the cash rate. It's also expected that there will be some rate cuts in the second half of 2023, so it'll certainly be interesting to see what happens. We can see with all these rate hikes, a bunch of borrowers are being hit. Anyone that has a mortgage is being hit. And we can see Kushik here, who has a $770,000 mortgage in North Sydney, finding it more difficult to pay as rates rise. And he's finding that the household budget is being eaten up by the fact that he's got to come up with extra cash to cover the mortgage. Now, he's 35 years old, IT risk manager, and he's had to cut discretionary spending from TV subscription services to groceries to planned trips to India for Christmas, and has had to even look at cutting his phone bill up. So he saved $50 a month from switching his phone provider to a cheaper plan, as well as internet plans with lower datas and dropping subscriptions such as Disney Plus and Stan. Guys, what do you think? Have you had issues struggling to meet repayments? We can see here on a $770 mortgage, since really the rates hike started, there's been $922 increase on the bottom line in terms of your mortgage repayment. Now, there are things you can do. So if you've had your mortgage for really more than 12 months, or even, you've not really looked at it and you're paying anywhere in that 4.5%, 5%, it's certainly time to review. 1% reduction on a $700,000 mortgage, that's $7,000 a year. Now that can cover for things like your discretionary spend, and you might not need to have to cut it out. So certainly something to look at. There's a bunch of lenders that have refinance rebates, so you can effectively get cash to refinance your loan. You're not going to be out of pocket for refinancing and effectively getting a lower rate. Plus, the refinance rebate will put you ahead and put you in a better position because there's been so many rate hikes, and we've seen the banks come out being even more competitive, searching for new mortgage lending and sharpening the rates. We've talked about it before where a bunch of lenders cut their variable rates. So in all these rate rises that we've seen, we've actually got lenders cutting their variable rates, which makes for an even better opportunity for those that have equity or ability to refinance to get their rates down and really combat against these rate rises. In the market at the moment, we're still seeing variable rates anywhere in that 3.5%. With yesterday's rate rise, obviously that's going to go up, but it gives you a bit of an idea on where the market is. And if you're looking at your mortgage and you're wanting to review it, feel free to hit us up at huntergalloway.com.au. We're mortgage brokers in Australia. We help Australia-wide, or visit our website, huntergalloway.com.au. Guys, thanks for watching.